two. 17 right here.
괜찮아 괜찮아 이런 일들 많잖아 꼬일 대로 꼬인 일들 주머니에 보낸 줄
Yeah. 흰 뒤에 뭐 묻을 때 교통카드 잔고가 없을 때 꼭 이런 날에만 집 가기 전에 비 맞기 나한테만 일어나시고 깜빡하면 주말은 가고 이거 왠지 나다 싶으면
As the introduction to the report outlines the importance of capital structure in corporate finance, which involve decisions regarding the mix of debt and equity used to finance a company's operation and expansion. It highlights the balance between debt and equity, emphasizing the benefit and risk of each, such as the tax advantage of debt and the financial flexibility offered by equity. The report also addressed the risk of financial distress, including both direct and indirect costs. Additionally, it introduced key theories like the packing order theory and signaling hypothesis, which explain how companies make financing decisions based on factors such as information asymmetry and investor signals. Overall, the report explores the factors influencing capital structure decisions and their impact on shareholder value.
The capital structure refers to the way in which the corporate finance activities, growth and investment from different sources of capital. These sources of capital mainly involve debt, the cash borrowed, and equity or ownership capital, whose combination influence a company's financial stability, risk profile, and cost of capital. Besides this, the capital structure is also one of the most important issues to corporate executives since it affects financial health, profitability, and market value of the company. The capital structure will refer to the mix of debt and equity available to fund the asset and activities of a firm. Two of the major items in the capital structure include debt capital and equity capital. Debt capital will involve things such as loans, bonds, and other forms of borrowed money that the corporation is obligated to pay back in due course of time. Debt capital could be either long-term or short-term, and it usually contains fixed interest payment. The advantage of using debt is that interest payments are tax deductible, which reduce the company's taxable income. The financial benefit known as the tax shield. Equity capital is money raised through selling common or preferred stock. Equity represents ownership of the business. Owners of equity have a claim on the corporation's profit in the form of dividends or through any stock price appreciation. Equity does not require periodic payments and has no obligation to pay dividends. Thus, when liquidation occurs, the equity investor is the last person to receive any rewards, therefore increasing the amount of risk. The capital structure of a firm depends on both internal and external factors. Among those, a cost of capital is one of the most important goals while selecting a form of capital structure. Normally, debt is cheaper compared to stocks since interest paid is usually allowed to be deducted from tax and the holders of debt obtain fixed returns. However, heavy reliance on debt will increase financial risk and cost of capital in the long run. This means that an optimal mix of debt equity pursued by every business to minimize the overall cost of capital. The internal and external variables influencing a firm's capital structure include the cost of the capital is one of the most important factors in choosing a capital structure. The cost of debt is generally less compared to stock because interest payments are deductible from tax and the returns to debt holders are fixed. However, over-dependency on debt will raise the long-term financial risk and cost of capital. It simply means that every organization aims for the perfect combination of both debt and equity so as to minimize the overall cost of its capital. Another reason includes financial risk and leverage. It is the dependence of business on the debt to multiply the equity's potential return. The more debt compared to equity in a company, the larger the financial leverage. Leverage can widen up earning during high economic growth. However, it also increases financial risk. Too much debt makes its settlement painful during low period of economic growth. It may even lead to bankruptcy. It therefore requires companies to weigh the risk associated with borrowing against the potential gains from leveraging up their resources. Lastly, there are the market condition. The financial markets condition is another factor that could impact capital structure decisions. For instance, in period of low interest rates, it cuts the cost of borrowing that may influence companies to assume higher level of debt. Conversely, if the conditions of the stock market are especially good, firms may decide to offer equity, particularly if they can sell more shares at higher valuation without substantially diluting ownership. The capital structure decision has broad ramifications for the company's operations, its risk profile, and financial stability. Among the significant results, return on equity is one. Debt financing can enhance a company's return on equity by the fact that it lets the creation of higher profits with less equity capital. But this means taking on extra financial risk. In the case of high returns, debt amplifies the earnings, while on the other hand, with a low level of return, the company is brought to a state of financial distress since it cannot afford to service the debt obligations. Second, there is the cost of capital and the issue of shareholder value, and correctly organized capital mix reduce the general cost of capital, increasing the value of the company to the shareholder. Companies can only achieve lower finance costs by balancing debt and equity, increasing profitability, and eventually greater share values. Finally, consider financial stability. On the other hand, over-reliance on debt may also insinuate impending liquidity problems or defaults of the company in question when it faces economic downturns or volatility in earnings. At the other extreme, an over-reliance on equity funding translates to possible dilute returns on investment. The best capital structure strikes a balance that ensures the company's financial stability in the face of economic unpredictability.
Next, I will be presenting about an optimal capital structure. So what is an optimal capital structure and how we can determine it as an optimal capital structure? Okay, firstly, an optimal capital structure is a capital structure that maximizes the firm's share price or that minimizing the cost of capital, or also known as the WACC. The high-level use of debt will lead to the company financial distress or financial risk to the shareholder. The lower the cost of capital, which means higher than the company market value. So, there are a few key factors that determine an optimal capital structure. The first one is cost of capital, the second one is financial risk, the third one is financial flexibility, and lastly is the market condition of stock. The first key factor is cost of capital. So, a company or a firm needs to plan on how to minimize the cost of capital, or also known as the WACC. The lower the cost of capital, or the WACC, shows that the company has an optimal capital structure. Usually, firms will experimenting with debt to equity ratio to show its impact on the WACC. Next is financial flexibility. A company or a firm needs to have a financial flexibility to secure its financing for future opportunities or also for emergency. The higher level of debt will decrease the flexibility of the company. Last key factors to determining an optimal capital structure is the risk. So we all know with high level use of debt will lead to financial risk or financial distress not only to the company but also to the shareholder. So an optimal capital structure usually has less financial risk. So the company needs to plan on how to minimize the risk of the debt or of the financing that they use. Lastly, the key factor to determining an optimal capital structure is the stock market price. These factors actually will give a bigger impact on the capital structure, and we can see the impact when the company try to issue an additional capital.
So, what are the factors affect capital structure and capital structure decision? Firstly, we have cost of equity. There is common erroneous conclusion that equity is free of any cost, which is that is not true. Dividend and flotation cost of issue are the cost of the equity capital. Second, change in control. Issuing new shares to the open market introduce new shareholders who can have significantly different understanding on how companies should be run. Third, debt covenants. Raising debt also usually imposes various debt covenants that restrict a proportion of a debt for the company is allowed to have. Next, regulatory framework. This prescribes how proportion of equity a company should have in its capital structure. And lastly, other factors. Cost of debt, tax rate, interest coverage ratio, cash, providing SCR, net operating income, capital structure of other companies. Now, I will continue with the next part, which is financial distress. Financial distress is a term commonly used in corporate finance to indicate the condition when a company's promise to creditors are broken or are met with difficulty. It also refers to any circumstance in which the person or business finds it difficult to make their bill payments, particularly those resulting from debt owed to creditors. So, in order to prevent the situation from getting worse, financial distress must be handled as soon as it arises. If financial difficulties are not immediately resolved, they may result in more financial difficulties. Distress costs are the monetary constraint that a business bears when it has severe financial troubles, which frequently occur before or during bankruptcy. These expenses consist of both direct costs and indirect costs. In the end, distress expenses reduce the firm's profitability and long-term sustainability. Thus, it's critical for business to properly manage their financial risk to stay out of trouble. Lastly, financial distress costs can also be categorized as ex ante, which is before the event, and post ante, after the event costs, depending on when they arise relative to financial distress or bankruptcy. The first one, ex ante, expenses made to reduce future risk in anticipation of possible financial difficulty. To guard against insolvency, business might take preventative measures including diversifying their funding sources, acquiring insurance, or keeping surplus cash reserve. The second one is post ante. These expenses appear after financial difficulty or bankruptcy has occurred. The immediate cost of legal and administrative action, as well as the indirect cost of decreased sales, low staff morale, tarnished reputation, and restricted access to funding, are all considered post-ante costs.
Next, we move to the part of the integration of tax effects and financial cost distress. A firm's capital structure decision involves a trade-off between the tax advantage of debt and the cost of financial distress. In corporate finance, tax effects generally refer to how a company's tax obligations, such as tax shield, influence its financial decisions, particularly related to financing and capital structure. One of the most important tax effects is the tax shield, where it allows a company to save on taxes by using debt. In many countries, interest paid on debt can be deducted from the company's taxable income. This means the company can reduce its taxable income by the amount of interest paid, resulting in a lower reported income. Consequently, the company pays less in taxes. This is called a tax shield because it helps protect a portion of company's income from being taxed by using debt financing. Next, we move to financial cost distress. Financial cost distress refers to the additional expenses a company incurs when it faces financial difficulties, which may lead to bankruptcy or other negative outcomes. These costs include direct expenses such as legal fees and administrative costs. There are also indirect costs such as the loss of customers, suppliers, and employees due to concerns about the company's stability. When a company is in financial distress, people's confidence in it can decline, which further affects its business. In these situations, companies may be forced to sell the assets quickly and at the low prices to raise cash, it is a clear sign of financial distress. Next, the trade-off theory of capital structure. The trade-off theory of capital structure governs the relationship between tax effects and financial distress, which suggests that companies need to balance the benefits of using debt with the potential cost of financial distress. When a company borrows the money, it can deduct the interest payments on the debt from its taxable income, reducing the amount of taxes it has to pay. This benefit, known as a tax shield, makes debt financing attractive. The more debt a company has, the greater the tax shield it can benefit from. However, borrowing too much also increases the risk of financial distress, such as struggling to meet debt payments or facing bankruptcy.
According to the trade-off theory, companies must balance the tax benefits of debt with the potential cost of financial distress so that it can ensure the benefits of debt outweigh its potential risk. The trade-off theory suggests that the optimal capital structure is achieved when the tax shield benefits from debt are balanced with the cost of financial distress. If a company continues to take on more debt beyond this optimal point, the tax benefits from additional debt decrease, while the cost of financial distress, such as the risk of bankruptcy, increase rapidly. Once debt exceeds a certain level, the cost of financial distress outweighs the tax benefits, making additional borrowing unprofitable. Therefore, companies must find the sweet spot where they borrow enough to gain tax savings but not so much that it leads to financial trouble. So, the graph here represents the integration of tax effects and financial distress costs.
The cost of equity related to agencies is a very important concept in corporate finance, emanating from the conflict of interest pitting a firm's shareholders against the management thereof. The primary notion of agency theory, developed by Michael Jensen and William Macklin in the 1970s, was that in the event of separation between ownership and control of a firm, the interests of both individuals involved may not always coincide. The shareholders would want to maximize the worth of the firm by increasing their wealth, but the managers appointed to run or operate the firm may have personal interests that are not in line with the shareholders' objective. These conflicting interests lead to a so-called agency cost, which is the financial consequence of such conflicts. There are a number of factors that contribute to the agency cost of equity, which themselves derive from the principal agent dilemma, whereby shareholders select managers to operate the business. For their part, the managers may prefer personal objectives such as job security, prestige, or salary to the maximization of profit for shareholders. Two factors affecting agency cost of equity are moral hazard and managerial discretion. Managers have wide discretion on decisions such as investment choice, reward system, and strategic focus. Since managers bear only a part of the consequences of bad decisions, they will make decisions that maximize their welfare rather than shareholder wealth. For example, it would imply that managers avoid risky projects that could yield high return so as not to jeopardize their job security or overinvest in very risky projects that benefit them at the cost of the shareholders. Second, make ineffectual investing decisions. Managers can make bad investment decisions either because they are personally rewarding or satisfy short-term goals, even at the expense of long-term shareholders' value. For instance, managers overinvest in projects that are uneconomical to prove growth or to catch up on earlier performance. Or they may underinvest in valuable projects just to avoid increased risk or to maintain a stable financial position that would guarantee remuneration or job security. Third, make dividend and payment decisions. Yet, another source of agency cost of equity is debate over profit distribution. Shareholders favor bigger dividends because they provide quick rewards, whereas managers may choose to invest earnings in the business to improve their own advancement and control of the company. For shareholders, the earning retention may be seen as an opportunity cost wherein, on the other hand, management wants to hold on to their cash resource and use it to either finance their pet projects or to maintain control. The difference in preference thus creates this excessive profits retention, wherein the management decides to retain the earnings within the company instead of paying out dividends to shareholders, even when these retained earnings are better utilized elsewhere or given to shareholders in dividend form. The agency costs of equity are inseparable from any corporation with separated ownership and control, but good corporate governance, incentive structures, and financial policies mitigate them. Firstly, there is incentive alignment with equity-based pay. Generally speaking, aligning the interests of the managers with those of the shareholders via equity-based pay is probably one of the most implemented approach aimed at mitigating agency costs. With stock option grants or performance-based compensation, personal wealth for managers becomes strongly connected with company performance. Stock options are restricted stock grants can allow managers to capture significant gains personally when the stock price rises for the company, aligning the financial interests of managers with those of the shareholders. Next is debt financing and monitoring. Debt is an alternative to equity-based incentive that can help restrain the agency costs imposed by equity holding managers because it forces managers to behave in certain ways. First, debt holders have a fixed claim on the firm's cash flows. Thus, they could put demands on management, called covenants, that would prevent management from taking some inefficient or risky actions. Threats of insolvency or financial distress due to the firm having high debt levels could force the managers from overstepping their boundaries. Finally, consider the company governance process. Effective corporate governance system can help minimize agency costs by making management accountable for their decisions. The main governance mechanism include boards of directors. A high caliber independence board will contribute to monitoring the activities of leading management and ensuring they act in the best interest of the shareholders. The board may also assess the performance of leading managers, set strategic directions, and determine principles for executive remuneration.
We're going to explore an important theory in corporate finance, which is the pecking order theory. This theory helps explain how firms make financing decisions, particularly why they prefer some sources of financing over others. Understanding this theory is essential for grasping corporate financing behavior and the trade-off companies face when choosing between debt, equity, and internal financing. So next, according to the pecking order theory, firms prioritize sources of funding based on their desire to avoid external financing costs and informational asymmetry. Here, how the hierarchy works. Firstly is internal financing. Firms prefer to use a retained earning or profit because it involves no additional cost, no interest, no dilution of ownership, and no need to signal to the market. Essentially, if a company can finance its project from within, it will. So, let's start with the basic. The pecking order theory was introduced by Stewart Myers and Nicholas Majluf in 1984. The theory suggests that firms have a preference for financing their operation in a specific order, starting with internal fund, followed by debt, and lastly issuing new equity. So, second is debt financing. If internal fund did not enough, firms turn to debt. Debt is preferable to equity because the firm doesn't have to give up ownership or control. Plus, interest payment on debt are tax deductible, which make debt financing more attractive. However, too much debt can increase financial risk and lead to potential bankruptcy. Lastly is equity financing. As the last resort, firm issue in new equity. This option is typically avoided because issuing equity dilutes existing shareholder ownership and may signal to the market that the firm is in financial distress or overvalued. So next, the pecking order theory has important implications for financial manager, information asymmetry and market signaling, and lastly, implication for financial distress and growth. So here are a few implications. First is financing behavior. Managers must understand the implication of their financing decision. For example, issuing new equity can reduce stock prices, so firms may prefer debt even when they could theoretically issue equity. Second is asymmetry and market signaling. When companies issue equity, they may be sending a signal to the market that managers think the stock is overpriced. As a result, investors may respond negatively, which could lower the share price. Lastly, financial distress and growth. Businesses that have minimal profitability or not access to internal funding may experience more financial difficulties if they take on too much debt because they won't be able to obtain equity financing. So, to summarize, the pecking order theory have explained why firms prefer internal financing over debt and debt over equity. This hierarchy is driven by desire to avoid the cost of external financing and the risk of signaling negative information to the market. It has important implications for corporate financing strategies, investor behavior, and market reaction. However, like all theory, the pecking order theory has its limitations and real-world financing decisions are often more complex. Nevertheless, understanding the pecking order can help us interpret corporate action and predict future financing choices. Okay, next we'll be diving into the signaling hypothesis theory, a key concept that plays an important role in financial decision making and market behavior, whether it's about investment decision, corporate behavior, or even hiring practices. This theory has a real-world application that can help explain the choice made by individual and firm in uncertain environments. Okay, so let's start with the basic. The signaling hypothesis suggests that when one party in the transaction has more information than the other, the informed party will signal their true intention, abilities, or quality to the less informed party. This helps reduce the information gap, allowing the less informed party to make more confident decisions. In the context of financial market or economy, the sender is the party with more information and the receiver is the one with less. The signal is the action taken by the sender to communicate this information, and the goal is to influence the receiver decision-making process. So, let's consider a corporate example. A company might want to raise capital by issuing new stock. However, investors may be unsure about the company's financial health. According to the signaling hypothesis, the company can signal its strength by choosing to issue debt instead of equity. This is because debt insurance can signal to investors that the company is confident about its future cash flow and has the ability to repay the loan. So, on the other hand, if the company were to issue equity, it might be interpreted as a sign that the company is struggling because issuing more stock dilutes existing shareholders and may indicate that the company cannot generate enough cash flow to repay debt. So, whether you analyze a company decision to issue debt or evaluating a potential employee qualification, always remember that signal method. They play a key role in reducing uncertainty and help all parties make more informed decisions. Thank you for your attention, and I hope you found this presentation on the signaling hypothesis theory helpful.